Welcome to our channel. Indirect lending in car financing refers to a process where dealerships act as intermediaries between buyers and lenders, facilitating loans for vehicle purchases. This method is significant as it allows consumers to access financing options directly through the dealership, often streamlining the buying experience. In this video, viewers will learn about various dealer financing tactics, including how dealerships may present financing offers and the potential benefits and drawbacks of these arrangements. Understanding these tactics is crucial for buyers, as it can significantly impact the overall cost of the vehicle. By being informed about different financing options, consumers can make better decisions, potentially saving money over the life of the loan. Knowledge of indirect lending practices empowers buyers to negotiate more effectively and choose the best financing solution for their needs. Ultimately, grasping the nuances of dealer financing can lead to smarter purchases and greater financial savings, making it an essential topic for anyone considering a car purchase. Don't forget to like, share, and subscribe to our channel. Your support is needed to help us get more money-saving and insightful content to our audience. Indirect lending in car purchases involves dealerships partnering with financial institutions to offer financing options to buyers. In this arrangement, the dealership submits credit applications on behalf of the customer to various banks or lenders, facilitating the loan process. This method plays a crucial role in dealership transactions, as it allows customers to secure financing conveniently while shopping for their vehicles. Dealers profit from these financing arrangements through a variety of means, including receiving a commission from lenders for each loan they facilitate and potentially marking up the interest rates offered to buyers. This markup can lead to significant profits for the dealership. The process begins when a customer selects a vehicle and fills out a credit application at the dealership. The dealer then sends this application to multiple banks, which evaluate the buyer's creditworthiness and provide financing offers. The dealership presents these offers to the customer, who can choose the best option, thus completing the indirect lending cycle while the dealer benefits from the transaction. In the realm of indirect lending, profits from financing arrangements are typically split between dealerships and banks based on the interest rates charged to consumers. When a dealership marks up the interest rate on a loan, the additional percentage often gets divided between the dealer and the bank. For instance, if a bank offers a loan at a 4% interest rate and the dealership presents it to the customer at 6%, the 2% difference is where the profit sharing occurs. A common split might see the dealership receiving 1% while the bank retains the other 1%. To illustrate, consider a scenario where a customer secures a $30,000 loan with a 6% interest rate. Over the life of the loan, the dealership could earn approximately $600 from the markup, while the bank profits from the original 4% rate. This arrangement creates financial incentives for both parties. Dealerships benefit from increased revenue through financing, while banks expand their loan portfolios, making indirect lending a mutually beneficial process. To negotiate better financing terms, consumers should first seek pre-approval from banks or credit unions before visiting a dealership. This step not only provides a clear understanding of what they can afford, but also gives them leverage during negotiations. With a pre-approved rate in hand, buyers can confidently approach dealers, using their financing offer as a benchmark. For instance, if a dealership presents a higher interest rate, consumers can reference their pre-approved rate to negotiate a better deal, potentially lowering the overall cost of the loan. Additionally, being informed about various financing options is crucial. Consumers should research different lenders, interest rates, and loan terms to understand what constitutes a fair offer. This knowledge empowers buyers to ask the right questions and challenge any unfavorable terms presented by the dealership. By combining pre-approval with thorough research, consumers can enhance their negotiating power, ultimately leading to more favorable financing terms and significant savings over the life of their car loan. Even when dealerships offer low or zero interest rates, they can still earn money through various mechanisms. One primary way is through flat fees that banks pay dealerships for each loan they facilitate, regardless of the interest rate. These fees can range from a few hundred to several $1,000s, depending on the lender and the loan amount. Consequently, even with promotional interest rates, dealerships can maintain profitability through these flat fees. Promotional interest rates, often advertised to attract buyers, can have implications for dealership profits as well. While these rates may seem appealing to consumers, they can lead to higher vehicle prices or additional fees embedded in the financing package. Understanding these fees is crucial for consumers, as it allows them to see beyond the surface of low-interest offers. By being aware of how dealerships earn money, buyers can make more informed decisions, ensuring they negotiate effectively and avoid potential pitfalls associated with seemingly attractive financing deals. This knowledge ultimately empowers consumers to secure better overall value in their car purchases. In the context of credit applications, the term shotgun refers to the practice of submitting multiple credit applications to various lenders simultaneously. While this approach may seem beneficial for securing the best financing terms, it can pose significant risks to consumers. Each time a lender conducts a credit inquiry, it can negatively impact the consumer's credit score. Multiple inquiries within a short period can signal to lenders that the borrower is in financial distress, potentially leading to higher interest rates or loan denials. To manage credit applications effectively, consumers should limit the number of inquiries by seeking pre-approval from a single lender or a few trusted institutions before shopping for a vehicle. This strategy allows them to gauge their financing options without overwhelming their credit report. Additionally, consumers should aim to apply for credit within a short time frame, as credit scoring models often treat multiple inquiries as a single event if they occur within a specific period. By being strategic about credit applications, consumers can protect their credit scores and enhance their chances of securing favorable financing terms. At CarQB, our concierge service at carqb.net leverages expert knowledge to negotiate better prices and interest rates for our customer. By leveraging advanced algorithms and data analysis, our experts assist consumers in negotiating better deals with dealerships, ensuring they receive fair pricing without the usual hassle. One of the key benefits of using our service to negotiations is our ability to analyze market trends and pricing data, providing buyers with insights that empower them during discussions with dealers. Our service eliminates the guesswork, allowing consumers to approach negotiations with confidence and clarity. Moreover, our service will save buyers valuable time by streamlining the negotiation process, reducing the need for back-and-forth communication with dealers. By utilizing CarQB, concierge service at carqb.net, consumers can enjoy a more stress-free car purchase experience, as they are equipped with the knowledge and support needed to secure the best possible deal. As the automotive market continues to evolve, our service will significantly enhance the car buying journey, making it more efficient and enjoyable for everyone involved. In this video, we explored the critical aspects of indirect lending and the various financing options available to car buyers. Understanding these concepts is essential, as they can significantly impact the overall cost of a vehicle and the buyer's financial well-being. We discussed how dealerships facilitate financing through partnerships with banks, the profit-sharing mechanisms involved, and the importance of being informed about promotional interest rates and fees. If you found this video helpful, please subscribe to our channel, like the video, and share it with others who may benefit from these insights. Together, we can empower more consumers to make informed decisions and achieve a successful car purchase experience.